Happy Friday, team. I know you're not used to seeing me on a Friday, but here we are. And the reason why is I think it's super important to explain kind of what happened yesterday, what's happening now. And this may get technical and I'll make it quick, at least try to. But the very last slide is probably the most important. So if you don't watch anything, at least fast forward and watch that. So let me show you guys what we're looking at now. So it's wee morning. I just got done the workout, but I thought it was important. So I'm making this before the day gets started. Part 2 of yesterday. So guys, the rates yesterday, as you saw midday, as I was kind of making this mid-morning, when I was making yesterday's video, I told you that we were down 140 basis or 130 basis points in mortgages, which was not good. I mean, again, normal days, 13 to 20 basis points. So 100 minus 130. Well, here's how it's projected to open up right now. They basically yesterday ended flat. So in the morning, it was down 130 and basically ended up the day flat. I think it was like -3. So what a wild day. And then it looks like today we might actually get a slight improvement, but here's the catch. Yesterday's volatility, just as an example, the S&P, like the stock market, the one that most of us know, only 5 times in history has it opened. I mean, yesterday was the 5th day of all the S&P's history, which is crazy. The market opened up down more than 2% and finished up more than 2%. I mean, it was a wild swing. If you guys were paying attention yesterday to your 401k, that was crazy, but that's how volatile it was just in the S&P. And the big reason, one of the very big reasons. So here we are. If you don't know who the prime minister is, you got Miss Truss over here. And so what she's basically done, and that's part of the reason why we're having this, rebound today, is she announced that she was going to have some a Friday update, if you will, as far as what they're doing. So she got a lot of grief because in September 23rd, they talked about a tax cut plan, a kind of a stimulus plan, if you will, which doesn't make sense because when you're stimulating the economy, that's inflationary, right? And everybody's fighting inflation, especially the UK with all the energy crisis they're having with the Russia-Ukraine war. So you guys can see their 10-year treasury is called a gilt, and that's this chart over here, and I'll come back to it in a second. But basically, her meeting this morning, you can see her in the upper right. This is from CNBC. She's reversing course. She's saying, hey, our tax cutting plan, we're not going to do that anymore. And also, by the way, the finance minister got fired and there's a new one named Jeremy Hunt coming in. So they're basically saying we haven't done a very good job. And it's like, no duh, managing this thing. And so and I get real technical real quick, just to give you an example. So why is all this stuff happening? Well, a lot of it, and it's not her fault, but it's certainly she's a catalyst for this. And this was from the Wall Street Journal this morning. It kind of, adds a little light to how everything's interconnected. So pensions, right? So I didn't know this, like a third of Britons basically have some sort of private pension plan. So in other words, you retire, you get paid by your employer, or not by your employer, but by the pension plan. When you retire and you get this pension, right? And that's awesome. That's great as a worker. Well, again, companies have to pay into those pension plans, right? They're the ones that provide the money for these pension plans. Well, back in 2008, and that's what I highlighted here, once, after the mortgage meltdown and rates were super stupid low, these pension plans have really low returns. And these pension plans have been around for a long, long time. So after 08, when they're investing in something super safe, like treasuries or gilts in this case, and they're putting their money somewhere super safe at very, very low returns, those returns don't keep up with the money they're paying the retired people, right? The pension, the money going out versus the money they're investing in is super low returns. So there's a deficit. So much so that, in fact, they put out a company, BHS, had to go bankrupt, I guess, and they've been around since 1929 because basically these pension funds are like, yo, we don't have enough money to pay these people that are retired. We need more money from you because the money we're getting on our investments are super, super low. So what's wild is they allowed, and it's over here on the left, they allowed the liability-driven investing. I've never heard of that, just so you know. But this LDIs, they let them say, okay, we'll go get loans or we'll get margins. We'll borrow money to basically cover this gap so that companies like BHS don't have to go out of business. Because when there's a gap, they have to go to these companies and say, we need more money. And that's part of what put the financial strain on BHS, who went out of business. And this is from 2016, by the way, but it's just one of the bigger examples. So to cover that gap, they go and say, hey, we need to go, they go get margin. They go get borrowed money. Think of it like a loan. And they go do this to make up this gap. Well, now with rates going up like they have, it suddenly says, oh my gosh, the money we're borrowing is costing us way more money. So to raise money to pay for this stuff, because they're getting margin calls, these lenders are saying, yo, we don't trust you anymore. Give us back our money. So they're getting these margin calls. These margin calls are coming back and they have to pay for that money. And how do they do that? They sell things like the 10-year gilt or these bonds or their treasuries or whatever they're investing in. So when they sell that, you get it to where essentially these LDIs are saying we need our money. And when they sell that, that creates this demand issue. And so all of a sudden you get this flood of supply coming in, and the demand hasn't changed, but the supply suddenly has because they're trying to sell it. So in order to create demand, rates go up. And so you guys can see just since August, kind of where things have been. August 22nd, in this example, their gilt was less than 2%. That's the equivalent to, again, of their 10-year treasury. Their gilt was less than 2%. Well, suddenly, the stimulus plan, look on September 23rd, and you see it just start popping up really big. And all of a sudden now you got this issue where they're trying to sell stuff, and to create that demand, the rates need to go higher. So this is why UK stepped in and say, we're doing this. But here's why it matters to us over here on this side of the pond. So our 10-year treasury, let's go back to that August 22nd time period. We were paying over 3%, right? So our treasury was paying 3% at that time for a 10-year note, and theirs was less than 2%. So it makes it to where, to some degree, all the money out there in the global money is going to come to our 10-year yields, and they're also going to come to our mortgages because they're also super expensive. So those are relatively safe. These are good investments. Well, now that Britain's gilt is going to be that expensive, suddenly they're higher than we are, right? So here we are today, less than 4%. They're over 4%. So now those two things are competing for global dollars. So in other words, if the gilt's going to be over 4%, you might see some, we're talking like countries and everybody who invests in these 10-year notes, if you will. So they're going to go over to the UK because they're paying more than 4% versus ours less than 4%. So our 10-year treasury may need to go higher in yields to attract and get investors to come to want to buy in. So that's also tied to our mortgages. And here's the most important. This is the last slide I was talking about. So all that's to say, I don't know if I did a great job explaining this because it is complicated. I'm trying to make it not too long, not too technical, but here's the part you guys got to see. This is what our capital markets people sent last night. And I'm not trying to scare you. I'm just trying to be real for where things are today, and how yesterday I said, hey, Freddie Mac posted 6.98 or whatever it was for a rate with 0.8 points. Guys, check this out. And you can pause it and read this. I'm not going to read it because I know you guys can do that on your own. But the highlighted yellow part, right? So basically there's a liquidity issue right now. Mortgage-backed securities are behaving so crazy that investors just don't know what to do and they don't want to buy them. And as I've been saying, I'm predicting rates will go back down. So mortgages, the people investing in mortgage-backed securities, they want years to make their money back. You don't make a ton of money real quick. It's a long-term thing. So if they think these mortgages are going away next year, they're going to charge a lot of money up front, like points, to kind of get that hopefully rate lower so it's less appealing to refinance later on. But guys, basically because of this, like you can see here, the highest available rate in the Fannie Mae cash window, and I know that's technical, but at the end of the day, is 7.625. So these are screenshots. The market hasn't opened, at least at the taping of this, it hasn't opened. But the top one, FHLMC, that's Freddie Mac. FNMA is Fannie Mae. And you're seeing it's costing 1.3 points to get these rates. Now, again, expired on the left means that the market hasn't opened. So obviously with what we saw earlier in the slides, things are getting better. But holy smokes, it's just a wild time right now. So all that's to say, I have a couple of you asking for rate sheets. Like, hey, where are rates? I don't know. I can't give you guys rates. I can't give you a rate sheet because I just don't know where things are going to be on a day-to-day basis. So I would just say contact your lender. And again, I go to Freddie Mac just because it's the most generic. It's once a week. It's on Thursdays before the market opens on Thursdays like yesterday, which can get you in trouble on a day like yesterday. But if nothing else, the takeaway from this is just saying the market is crazy. And we've known that, but these are just really good examples how you've at least seen it now, because a lot of this happens behind the scenes where only mortgage folks know about it or the capital markets folks know about it. But yesterday with the S&P volatility, it's a really good example how just interconnected we are, right, globally. So things that the UK is doing and their problems do become our problems, whether it's our treasuries or our mortgages, because we're all competing for money, right? Mortgage-backed securities, when do rates go lower is when people want to invest in mortgage-backed securities. Right now, they don't like them because, again, they think they're going to go away and maybe inflation keeps going up. So until inflation comes under control and until the UK gets their act together and sets some sort of stability in the markets, we're going to have a lot of fun with volatility in the near future. So I do think, again, rates are going up, in my opinion, for the next 30 to 60, maybe 90 days. I think we got the rest of the year, going up through November, maybe some December. I'm thinking and hoping rates should flatten out start of the new year and maybe start coming down. And I do think in the next 12 to 24 months, we will see rates substantially lower than where they are today, assuming we get inflation and assuming there's not World War III and all that other stuff. So sorry for the long watch. I know it's Friday. If you've already tuned out, I get it. If you haven't, thank you for watching. Call me if you have any questions. I now got to go shower and get ready for the day. Bye, guys.